strategies for selling options. A common strategy is a short put, and I think just understanding the short put is very helpful as a building block when you learn about other strategies, because you're going to recognize that butterflies, broken wing butterflies, all the vertical spreads, all these strategies that we hear, it's all just starts off with one contract, and then we build onto that one contract and add more contracts, which change it into all of these unique names that we have for options. And then we have a short call. You know, in a call option to collect a premium, often used on assets traders think will stay neutral or fall. As you know, here at Tasty, selling options, one of the pros to that is being able to capitalize on two directions in the market, whenever it moves sideways and whenever it goes down or goes up, depending on your directional bias. So we know if we're trading futures or if we're trading stock, we don't have that luxury. The stock is moving sideways, we're probably going to be up a little bit, down a little bit. It's going to be consolidating, but we're not going to move anywhere. And if that's the case with selling options, if it stays within a range, then you're actually going to be making money, because as we know, options lose value as we get closer to the expiration date. And as we know, whenever we're selling something, whenever we're shorting something, we're shorting options. We understand we make money when the asset value drops. So again, if these options are losing value as we get closer to the expiration date, because time is running out and the value is going down, and we're the ones shorting the contracts, you can see how that's going to work in our favor. Because if we were shorting stock, we want the price of that asset to go down. If we're shorting futures, we want the price of that asset to go down. So when we're selling premium, we're shorting options. We want the value of those options to go down as well. And that's why option sellers make money, because the value of those options are going down. So iron condors, we talk about this one a lot. It's a limited risk, high probability strategy using both calls and puts to profit in neutral markets. So we know when we sell a put spread, an out of the money put spread, that's a bullish strategy. When we sell an out of the money call spread, that's a bearish strategy. And whenever we sell those two things simultaneously at the same time around the stock price, we understand if the stock price stays within that range from the top and bottom that we sold those vertical spreads, we'll make money, because it's essentially putting on two opposing positions, but we're capitalizing on both of these positions by the sideways movement of the underlying. Because if it's staying sideways within that range, it's a lot of theta that's getting sucked out of the contract as we get closer to its expiration date. And then strangles and straddles, we don't do these as much with smaller portfolios, but selling calls and puts around the current price, which is a strangle, or at the same price, which is a straddle, to capitalize on low volatility. And it's pretty much a similar thing to the iron condor. The only thing that's different from a strangle is it's not defined risk. With an iron condor, we're buying those outside wings. And a strangle is pretty much the same thing as an iron condor, but we're selling it naked. We're selling the call, we're selling the put, but we're not buying those outside wings to create a defined risk strategy. So it's pretty much the same strategy, but without doing that, you're going to need a little bit larger buying power in your portfolio, because we know when we buy those outside wings and hedging it, it reduces the amount of buying power that we need for that trade. So again, it's pretty much the same thing.
A little more,
but it's a little more aggressive. Yeah, you can collect more premium. And if the more premium you collect, the more potential profit you have on the trade. So let's jump to the next slide. Managing risk and position sizing. I mean, position sizing is an antidote to 99.9% of trading problems. And allocate a small percentage of capital per trade to manage risk and avoid significant losses. And defined versus undefined risk. His trade recommends defined risk strategies for beginners. That's where I started whenever I was doing Where Do I Start? The Where Do I Start series on the live show with Tom. 9 out of 10, I would say 9.5 out of 10 strategies were defined risk, which is going to be iron condors, vertical spreads, things of that nature. And then understanding margin requirements for undefined risk trades, which we were just talking about margin requirements when we were talking about the buying power that's needed for a defined risk strategy versus an undefined risk strategy. So it's going to be dependent on your comfortability level, your risk level, and then also your portfolio value and your experience level. Rolling and adjusting. Tasty teaches rolling positions, moving to later expiration to reduce risk or increase chances of profit if the trade goes against you. So sometimes if a trade isn't going in our favor, one thing we can do, instead of closing the position and days have been going down, we can actually add more time to those trades. So we can actually roll out in time. I don't think we've used an example of that here on the segment yet, but one thing we can do is, let's say we're at 21 days to expiration. We started at 45. If we still have on the same bias, even though the trade is working against us a little bit, If we still want to keep that trade on, we just want to give it a little bit more time and maybe it'll turn around, or whatever hypothesis you might have, we can actually roll out in time.
Yeah.
So we can actually add more time to those contracts and keep the same position on, but add more time to it. So that's one thing we can do. That would be a form of rolling and adjusting. And then now, probability of profit, otherwise known as POP, focuses on trades with 60 to 70% POP, balancing probability with acceptable risk. So whenever we're putting trades on, a lot of the times that sweet spot is going to be between 60 and 70%. Sometimes when you sell iron condors, it might be 50, 53, 54, 55%. Usually those are a little lower, but if you get an iron condor for 60%, just know that's a really solid probability of profit to have for something like an iron condor. But whenever you're selling an out of money vertical spread, you might get something near a 60, 65. One of the benefits about going undefined risk is you actually have a higher probability of profit. You have a potential higher risk for loss, but again, there's trade-offs. There's pros and cons to defined risk strategies, pros and cons to undefined risk strategies. Yeah. And with an undefined risk strategy, you're typically going to get a higher probability of profit. So if you sell an out of the money put, it's not going to be, uncommon for you to get a 70% probability of profit, or even more than that, depending on how far out of the money that you're selling. So again, it's just about balancing probability with acceptable risk. And then we'll just jump into the last slide. Metrics and execution tips. Delta and theta. Delta measures price sensitivity, while theta represents time decay, critical for the short option strategy. So if we put on a position, we recognize it has a -7 delta. That's how many dollars, all else equal, that's how many dollars we will be collecting in theta decay as each day passes. Yeah. And if we have a delta of, let's say, +5, that means if we put on a position that has a delta of +5, that means, let's say it's Apple, and we put on this position in Apple to get long, and Apple's currently trading at $200 and we have a delta of 5. That means we'll make about $5 each dollar Apple goes up.
Yeah.
So sometimes we can really gauge our expectations with profit and loss by looking at delta. So you can see, again, delta measures price sensitivity. Mm-hmm. So we just use an example of 5. Let's use an example of 50. And Apple stock price is at 200. We put the position on. We have a +50 delta. That's a little bit more aggressive. That means every dollar Apple moves up, we're going to make $50. Yeah. So you can see the higher the delta, the more sensitive your P&L is going to be, positive or negative. So if you have a -50 delta, that means every dollar Apple goes down, you'll lose $50. So it just gives you a better idea for profit and loss. Implied volatility, you're selling options in high volatility environments. As premium gets higher, allowing for potential greater for profits, because if premium is higher, it's going to let us sell premium at a higher price. And we know the max profit we can make on a trade when selling options is how much we sold the option for. So if I sell an option for $2, which is $200, the most I can make on that trade is $200. That is the max that I can make. So for selling options in higher volatility environments, we're going to be able to sell those options for a higher premium, which in return will give us higher profits. That's why implied volatility is important. And then choosing expirations. AC Trade typically uses 30 to 45 days to expiration to capture optimal time decay. They have a lot of research and data behind this. So that is the reason why we'll start looking at these options and selling them around 30 to 45 days whenever we're in the platform. Yeah, because we get it from data and we kind of want to lean on the data. And then we have exit strategies. Consider closing option trades at 50% of maximum profit to lock in gains and reduce exposure to reversals. As we know, one of the worst feelings in the market is being up a fairly decent amount and the trade ending up going against us. I think that happened to me within the last 2 weeks, and I showed the perfect example for that. So that's one of the worst types of trades that you want to be in. So having a good idea on what percent you want to get out of these options for is just going to help the thought process. One of the most difficult parts about trading is knowing when to get out. It's kind of easy to get in, but whether you're getting out in the profit or for a loss, sometimes that can be the most difficult part about trading. So whenever we have an option that we're selling, we're at 50% of the potential profit that we can make on the trade. So if we sold an option for $2, that means we're going to try and get out of this for a profit whenever the trade is at $1, because that means we're going to be at 50% of the potential profit, which would be $100 in that example. And then continuous learning. I think it doesn't even matter what niche you trade in. It doesn't matter if you sell options, buy options, trade futures, trades only equities, trade crypto. It really doesn't matter. It doesn't matter your experience level. It doesn't matter. Nothing matters. It doesn't matter your niche experience level, what you've done in the past. You always have to have continuous learning. You always have to have that mindset. Tasty Trade provides ongoing education. It's another resource That's extremely helpful. You follow along with videos, practice paper trading, and refine based on experience. So that's always a way that you can start, test certain strategies until you get comfortable, use your hard-earned money. Taste Trade doesn't offer things like paper trading, but you can find other resources to at least learn what a platform is like before you're using your hard-earned money. I want to know what these buttons do. You want to get a good gist for how the market is moving before you're using your hard-earned money, or just start with very, very small size. These are the 3 slides we just wanted to quickly break down for why we might sell options, what are some of the benefits, and just giving a little bit more perspective on selling options. So